Last week, I released a video titled 4 TFSA Mistakes to Avoid, and the audience seems to have really resonated with that video. Obviously, no one wants to commit any mistakes, especially relating to investing. Well, it so happens that I had written out quite a few more of these tips and mistakes than that initial 4 featured in the previous video because I wanted to make this somewhat of a mini series on the channel if the audience was up for it. And upon asking you all in that previous video, the general consensus was that yes, another video on this topic would indeed be of interest, so that's exactly what we're going to be diving into in today's video. I really hope you enjoyed. If you do, please take 2 seconds to drop a like on this video. It really helps the channel out, and let's get right into it. Hey, what's going on everyone? It's Griffin here, and I hope you're all having a great day as always. If you're new here, then welcome. On this channel, we speak about all things investing, from specific company analysis, real estate, and general investing knowledge, like in today's video. So if you're looking to grow your wealth and expand your knowledge through investing, then make sure to subscribe to the channel and hit the bell button so that you're notified whenever I release new and upcoming content. As mentioned, in today's video, we're going to be diving into a part 2 of the investing tips and mistakes series with another set of 4 main points that I believe all investors should be well aware of. Again, the information held in this video isn't in any particular order, so we're just going to be going through each one of the 4 one by one, and hopefully some of these will bring you some new and added value. So let's get right into the first one. And by the way, if you're still looking to open up your own brokerage account to start investing and trading stocks, then make sure to check out one of the 2 links down in the description to open up either a Questrade or a Wealthsimple trade account, and you'll get some free money when you open and fund your account. So let's get right into the first one. Alright, so the first tip that we're going to be covering today is once again related to the TFSA, in the same sort of vein as the tips in the previous video, but this time, instead of speaking about the contribution limit and how that can be affected based on your investing and trading, I want to speak about what ends up happening if you do end up over contributing to your allocated contribution room, because this seems to be something that isn't 100% understood by all investors that watch my videos. Let's first recap the contribution element of the TFSA. So as an investor in Canada, you can contribute to your TFSA up to the total allowed government contribution room, which is cumulative for each year after you turn 18. Now you can contribute that exact amount out of your pocket, and then also over time, as the value of your investment portfolio has grown within your TFSA, if you so choose to sell some of your investments and then withdraw some of your funds, well, the next calendar year, you can go ahead and recontribute all the way back up to the previous value of your portfolio, even if it had exceeded that cumulative government contribution limit. That's essentially one of the main points that we learned in the previous video, and if you want further explanation on this, I would highly recommend that you check it out after watching this one. There's a link down in the description. But what ends up happening if you over contribute to your TFSA's contribution limit, either by accident or even on purpose? This is a viable question that I've been asked by audience members, and it's important that everyone knows. Quite simply, if you do end up over contributing to your TFSA, the amount of the over contribution only will be subject to a 1% tax per month that you don't correct this situation. For example, if your contribution limit is $12,000, but you go ahead and contribute $20,000, well, you're in a position where you've over contributed $8,000 to your TFSA, and for this reason, you'll be subject to a 1% penalty tax on the entire $8,000 for each month that you stay in that position of over contribution. Over a 3-month period, that would represent $240. That is 1% of $8,000 multiplied by 3 months, equaling $240 in penalty taxes. Now here's the thing though, you might not be aware of your over contribution at all, otherwise you probably wouldn't have done it in the first place. If this does end up happening, the CRA will alert you of this over contribution, at which point you can take action to correct the situation and also pay any taxes owing. If you realize that you've over contributed yourself without the CRA even having to get involved and let you know, well, you can just withdraw those funds and therefore get yourself out of a period of over contribution, but you will still probably have to pay a penalty tax for that 1-month period on the over contribution. Alright, so I'll end this point in mentioning that it's really important that you stay on top of your contribution limit and fully understand how the TFSA works moving forward. And if you want any more information relating to the TFSA, then make sure to check out one of the 2 videos that I'm overlaying right here, where you're going to get some added context and understanding of the TFSA. Moving on to the second point in today's video, this one is also going to be related to the TFSA, in that the TFSA is a fantastic investment account in order to grow the value of your investments tax-free, relating to both capital gains as well as dividend income. This is true for practically all forms of investing within the TFSA. However, I'd like to reiterate here for anyone who might be new to investing, having just got into the markets within the last year or so, that the TFSA is meant for investing and not short-term speculative trading. Now, this is a topic that I've actually made a full standalone video to that I'd highly recommend you check out if you haven't already, but since that video was published roughly a year ago, I thought I'd make a refresher here, since this could be something that would be easily confusing, especially in the current market environment where we're seeing stocks rallying 50, 100, 200% in very short time frames. Basically, there are two forms of income that the CRA recognizes in regards to investing. We first have investment income, which groups together capital gains as well as dividend income, which is not going to be taxable in the TFSA, except for a couple exceptions here and there. And then we have what the CRA deems as business income, which is going to apply to the activities that day traders and short-term speculative traders are going to fall under, where they're trying to create a main source of income from their trading activities instead of using their investment account for, well, investing. The reason why they categorize day trading as business income, and for this reason it will be taxed as such, is because this type of activity of trying to create short-term gains on a consistent and reoccurring basis is not necessarily investing that's going to be subject to capital gains, which are taxed at a favorable rate outside of a TFSA in a cash account because, well, it's an investment that you're creating a capital gain on. With day trading, you're very much trying to create a source of income for yourself. Now, I'm not going to get super technical about all of this in today's video, but I really just want new investors here to realize that the TFSA is meant to be a tool for growing your investments over time, and for this reason, you'll be rewarded with tax-free gains. And keep in mind that the TFSA is a registered and regulated account by the CRA, so they keep track of all the transactions that happen within these accounts. With all this in mind, if you buy and sell some stocks within a short time frame every once in a while, then no, you really have nothing to worry about here. But if you think that you can buy and sell stocks day in and day out on a consistent basis that's growing the value of your TFSA all tax-free, then no, chances are the CRA will be flagged and this activity may be deemed as business income, unfortunately. And here's a list of some of the criteria that the CRA deems to be worthy of business activity within a TFSA. We first have the frequency of trades, the duration between trades, intention for resale at a profit, which is sort of a gray area because of course when you're investing you have the intention of reselling your investments at a profit later on down the road. However, I really just think this means buying a certain position with the intention of reselling it in a really short time frame on a consistent basis in order to create a profit. Now, the next thing we have is nature and quality of securities, and then the time spent on trading activities. Now, for practically everyone watching this right now though, this just won't be an issue. Even if you make some short-term trades every once in a while at a nice gain, well, this is fine and completely normal at the end of the day. I just want everyone here to be mindful of the fact that if you're looking to actually day trade on a consistent basis and look to grow the value of your portfolio through day trading activities, well, this could be subject to getting flagged by the CRA, and for this reason, it could be deemed as business income. That's just something that I wanted to bring up in case you were not aware of it. Alright, moving on now to the third point in today's video. This one is actually not going to be related to the TFSA, rather it's a general investing tip where I see a lot of investors, especially new investors, spending a lot of time worrying about their exact entry point on a given stock or other position, down to the exact minute on when they place their order, trying to time the market perfectly to their advantage. Now, I'm not saying that it's not important to think about your entry point on a given stock or other position, because of course the price point on which you get in is going to dictate your overall return on investment as the value of that stock or other position grows over time. If you buy into a stock at the bottom of a trend, well, chances are that over time the value will increase significantly, and the opposite is also true of if you buy at the top of a peak rally, well, chances are that you're going to experience at least a short period of time or extended period of time where your position is in the negative. So of course the entry point on a position is very important. However, what I'm speaking about here is new investors really focusing all too much on the actual exact entry point that they're getting in on a stock, rather than focusing on their overall strategy and researching new and upcoming investments. With that said, if you're a market investor such as myself, rather than being a speculative trader or a day trader, well, chances are that you've conducted extensive research on the given company that you're looking to invest in the first place. For this reason, you all know that when I personally take a position in a stock, well, I've conducted extensive research on the company in question, and I typically will have a multiple year time frame ahead of me for that investment, and if I do happen to have a shorter time frame for a given position, well, I'll always have an exit strategy for that investment. With this in mind, the exact entry point on which I get in on a stock isn't of all that much worry to me because I've conducted proper research on the company, and for a multitude of reasons specific to my overall investing strategy and the company in question, I feel comfortable in investing into that company for an allotted period of time. In the big picture and over the period of time that I actually hold the stock, a 2 to 3% variance on the buy-in price is not really going to matter all that much, and I see a lot of investors, especially new investors, really getting hung up on trying to time the market perfectly, which we all know is practically impossible, at least on a consistent and reoccurring basis. For example, this here is the Nasdaq 100 ETF HXQ offered by Horizons Investments that I've spoken about many times on the channel and have been holding on to for years now. I've purchased shares of HXQ here, and will continue dollar cost averaging as I go along. Even though I might be buying on an up or a downtrend, I view corrections as an opportunity to lower my cost basis, and anyways, I believe in this index over the long term. I will say this though, that I've mentioned previously and still believe up to this day that you should only be buying stocks on down days, because at least this will allow you to lower your cost basis on a very short time frame. And finally, for this point, unless you're looking to actually start day trading, always remember that when you're investing into stocks, you're actually investing into a company itself, and over time, if a company does well, the stock will typically follow. This leads me into the fourth and last point for today's video, which is jumping into investing head first without properly defining your overall investing plan and strategy. The reason why I'm mentioning this is because I know a lot of individuals have just started getting into investing within the last year or so during the March crash specifically, and while this is fantastic and I'm very happy that more individuals are taking their finances seriously, it's somewhat scary to me seeing people buying and selling pretty much anything with little to no inner reflection about their overall investing strategy and how each stock or other position fits within it. I started this channel with the goal of helping as many people as possible reach their financial goals, or at the very least get more individuals interested in money, saving, and investing for their future. Now, this has since morphed into a channel where we speak about various different investing topics, which I absolutely love, but I see people all the time asking me what my thoughts are on this stock or that stock, this ETF, that ETF, and a whole bunch of other investments. With the ease of access now to investing through mobile trading platforms, which I absolutely love what these platforms have brought to the table for investing, well, it's still paramount to treat these platforms for what they truly are, which is investing with your real money. For this reason, I believe that it's absolutely paramount for all investors to really think back to the basics here and identify who they are as an investor, what their time horizon is, their risk tolerance, as well as really just what they want to get out of investing in general. Throwing random amounts of money at various different growth stocks might seem like a good idea, but in practice and when you actually track your results over a mid to long-term period, it's always going to be more beneficial to actually define your overall strategy, goals, as well as your proper asset allocation for each position. For example, in my portfolio, since I'm a younger investor, I typically keep around 90 to 95% of my portfolio in equities, and then from there I will further divide that up into various different stocks and ETFs that I feel comfortable with after conducting proper research. In the context of this video, I say that it's a tip here, but in reality, this is actually the most important element that I've spoken about in this entire video, and it's critical for long-term success in investing, so definitely don't skip on this one. Now, if you haven't checked out the part 1 to this video series, then I highly recommend you do. I'll leave a link down in the description, and I really hope you enjoyed today's video. If you did, please make sure to drop a like. It really helps my channel out, and make sure to let me know down in the comments what you thought of each one of these 4 elements, whether or not you agree with them or have any comments to add. If you also want to learn more about investing in general and various different investing topics, then make sure to subscribe to the channel and hit the bell button so that you're notified whenever I release new and upcoming content. On that note, thanks a lot for watching today's video, and I'll see you in the next one.